Welcome back to Barawakar.com, your trusted source for financial updates, market insights, and strategic analysis. Today, we're diving into the global stock market turbulence triggered by renewed US tariff threats against the European Union. From European indices dropping to cautious optimism in Asia and key data from the US and China. This is your full global market wrap. Let's get started. World shares edged lower on Monday as President Donald Trump threatened to impose a massive 30% tariff on EU goods, escalating trade tensions once again. The pan-European STOXX 600 index fell by 0.3%, while MSCI's World Index dipped 0.1%. The only major market that bucked the downtrend? The UK's FTSE 100, which climbed 0.4%, thanks to strong performances in energy and commodity sectors. This tariff threat, although still in the realm of politics and rhetoric, is already making investors nervous. And it comes at a critical moment for global financial sentiment. The biggest concern lies in Europe. President Trump's threat, if implemented, would disproportionately impact major European economies, especially Germany and France, which are key exporters of automobiles, aerospace components, and luxury goods. In fact, German automakers like BMW and Volkswagen saw immediate intraday selling pressure. France's CAC 40 also dropped amid fear of pricing pressure on global brands like LVMH and L'Oreal. Experts say this could be pre-election posturing, but it's enough to shake market confidence, especially when combined with the ongoing economic uncertainty in the Eurozone. Interestingly, while Europe struggled, Asian markets showed some resilience. China's stock indices, which opened weakly, rebounded toward the end of the trading day.
Why? Because investors expect the Chinese government to roll out stimulus measures and boost domestic economic activity. Plus, the upcoming China GDP numbers this week are expected to show modest growth, a critical factor for both regional and global investors. The Shanghai Composite Index ended slightly higher, reflecting cautious optimism despite broader global headwinds.
Back in the US, the spotlight is now on the upcoming CPI data, or Consumer Price Index, which is the key inflation reading due this week. Why does this matter? Because the Federal Reserve uses this number to decide on interest rate moves. If inflation is higher than expected, we could see a bond sell-off, weakness in tech stocks, and potentially another rate hike later this year. In short, a lot is riding on these numbers. Here's a quick snapshot of how global indices performed. STOXX share saw Europe minus 0.3%, FTSE 100, UK, JOR 0.4%, MSCI World Index minus 0.1%, Shanghai Composite JOR 0.2%, DAX, Germany, minus 0.4%, CAC 40, France, minus 0.3%.
Overall, a mixed picture, with sentiment fragile and direction uncertain.
Market analysts from JP Morgan and HSBC had this to say. Markets are hypersensitive to trade-related developments now. Investors are defensive, preferring high-yield and dividend stocks. Volatility may rise further if tariff threats escalate. So, whether this is a temporary dip or the start of something more prolonged depends heavily on the tone of future US government statements, diplomatic response, US inflation, and China's economic numbers. So what should investors do right now? Here are 4 smart strategies. Avoid overexposure to export-heavy European stocks. Watch for inflation data before taking long positions. Look into defensive sectors like FMCG, healthcare, and utilities. Consider dollar cost averaging in quality stocks if market dips deepen.
This is a time for caution, not panic. Trade tensions may cool, but the data coming this week will set the tone for the month.
To wrap up, global markets are nervous. Europe is under pressure. Asia is cautiously optimistic. All eyes now turn to key economic indicators. That's all for this global market update from Barawakar.com. Don't forget to subscribe, follow, and share for daily market summaries, stock updates, and economic insights.